Everybody told you the monster was dead. The pundits were on TV doing victory laps, the White House was tweeting about mission accomplished on inflation, and your neighbor, Steve. You know Steve, the guy who confidently told you Bitcoin was going to $1 million in 2021. Steve was telling you mortgage rates were about to plummet. And then, on a random Tuesday morning in June, the Bureau of Labor Statistics dropped a number that made every single one of those people go quiet: 4.2%. That was the Consumer Price Index reading for the 12 months ending in May 2026, the highest annual inflation rate America has seen since April 2023, when we were still climbing down from the post-pandemic insanity. Let me put that in context so it actually hits you. In January of this year, the annual CPI was sitting at 2.4%. By March, it was 3.3%. April, 3.8%. And then May comes along and prints 4.2%. In roughly 3 months, headline inflation doubled. Think about that for a second. The price of everything you buy: gas, groceries, rent, your kids' daycare, the coffee you're drinking right now. The rate at which all of that was getting more expensive literally doubled in 90 days. And the thing that makes me, Kunal, genuinely worried, and I run failed finance, so you know I've seen some ugly data, is that people are still confused about what's actually driving this and what the Federal Reserve is going to do about it. Because here's the real story, nobody on. Cable news is explaining properly. This inflation spike isn't one clean narrative. It's at least 3 different forces smashing into each other at the same time, and unless you understand each one, you're going to make terrible decisions with your money. Force number 1 is energy, and this one is brutal. The Iran conflict that kicked off in March sent shockwaves through global oil markets in a way we haven't experienced since the early days of the Ukraine situation, the Strait of Hormuz, which, if you're not a geography nerd, is this tiny choke point in the Persian Gulf through which roughly 20% of the world's oil passes every single day. That strait got disrupted. The result? Gasoline prices shot up 40.5% year over year by May. Fuel oil went up 58.9%. The broader energy index surged 23.5% over 12 months, and the BLS specifically noted that energy accounted for more than 60% of the total CPI increase in May. 60%. That one. Sector drove the majority of the inflation print. So when some talking head on CNBC says inflation is back, what they really mean, but don't have time to explain in a 3-minute segment. Is that an energy shock caused by a war in the Middle East is rippling through every supply chain in America? Every truck that delivers your Amazon package runs on diesel. Every airplane that moves people and cargo burns jet fuel. Airline fares were up 26.7% year over year. That's not because airlines got greedy. It's because the fuel that goes into a 737 costs dramatically more than it did 12 months ago. And that cost gets passed to you, the passenger, every single time. Now here's the twist, and this is where it gets genuinely interesting. Force number 2 is tariffs, and this is the one that was actually the dominant inflation story before the Iran situation made everyone forget about it. Do you remember earlier this year when the tariff headlines were everywhere? The effective tariff rate on imported goods got jacked up from about 2.1% all the way to 11.7% by January 2026. Stanford's Economic Policy Institute published research showing that the pass-through to consumers now exceeds 50%, meaning more than half of every tariff dollar ends up in your shopping cart. And here's the Goldman Sachs number that really stuck with me. They projected that the current tariff regime would raise inflation by a full percentage point between the second half of 2025 and the first half of 2026. A full point. In an environment where the Fed is desperately trying to get inflation from 3% back down to 2%, a tariff-driven 1-point increase is enormous. Goldman also estimated that 72% of tariff costs have passed through to consumer prices after 12 months. That pass-through alone has added 0.8 percentage points to core PCE inflation, which is the measure the Fed watches most closely. So you've got war-driven, energy costs slamming headline inflation and tariff-driven goods costs quietly pushing up the core. 2 forces hitting at the same time from completely different directions. And force number 3? This one's more subtle, but it might be the most important for the long run. It's shelter. Housing costs, rents, the way BLS calculates owner equivalent rent. Shelter makes up more than a third of the entire CPI weighting. In May, shelter was up 3.4% year over year. Now, that's actually down from where it peaked, and the monthly shelter increase slowed from 0.6% in April to 0.3% in May, which is encouraging. But 3.4% shelter inflation by itself is above the Fed's 2% target for the entire index. Just housing alone is higher than where total inflation is supposed to be. That tells you something deep about the structural challenge here. Even if oil prices collapse tomorrow and every tariff gets reversed, housing costs are sticky enough to keep. Inflation elevated for months, maybe years. Have you felt it? Honestly, drop a comment and tell me. What's the item or the bill that's hit you the hardest this year? Is it gas? Is it rent? Is it groceries? I read every single comment, and I want to know what's actually squeezing people right now, because the data tells one story, but lived experience tells another. And sometimes the gap between those two is where the real truth lives. Now, let's talk about the main character of this entire drama. Because we have a brand new Federal Reserve chairman, and his name is Kevin Warsh, and what he did at his very first FOMC meeting in June tells you everything about where this country's monetary policy is headed. Warsh was sworn in as the 17th chair of the Federal Reserve on May 22, 2026, after being confirmed by the Senate in a razor-thin 54-45 vote, the most contentious confirmation in the Fed's history. Trump appointed him. Let's just state that plainly. The president wanted someone who would be friendlier to rate cuts, who would make borrowing cheaper, who would keep the economy juiced heading into a political cycle. And here's the irony that nobody predicted. Warsh walked into his first meeting, sat down at that table, and essentially told the market that price stability, beating inflation, is now the Fed's singular obsession. He used the phrase price stability roughly a dozen times during his press conference. He looked at the cameras and said, and I'm paraphrasing here, that the FOMC's commitment to deliver on its 2% inflation objective is strong, unanimous, and unambiguous. He said they've missed that message for 5 years and they're going to fix it. That is not the language of a chairman who's about to slash interest rates because the White House wants him to. That is the language of a man who understands that if the Fed loses credibility on inflation, the consequences are catastrophic. Not just for Wall Street, but for every family in America trying to buy a home, save for retirement, or just keep the lights on. And then he did something even more fascinating. He refused to submit his own dot. If you don't know what the dot plot is, it's this chart the Fed puts out where each FOMC member shows where they think interest rates should be at the end of the year, the end of next year, and in the longer run. It's basically a visual poll of the committee. Warsh chose not to submit his personal projection. He confirmed during the press conference that he has long opposed the kind of forward guidance the dot plot represents, arguing that it handcuffs future decisions. He let his 18 colleagues submit their dots, and the picture those dots painted was stunning. The FOMC split 9-9. Half the committee expected rates to stay where they are or get one cut, and the other half saw at least one hike coming before the end of 2026. The median dot actually pointed to a quarter-point increase. That means the central tendency of Federal Reserve opinion. The people who literally control the cost of money in the United States tilted toward making borrowing more expensive, not less. Markets did not like this. The major averages dropped after the announcement. The policy statement itself was a different animal too. Only 130 words, which is wild if you've been following the Fed for a while. Under Jerome Powell, those statements ran over 300 words and were filled with lawyerly qualifications. Warsh stripped it down. Simple. Declarative. We will deliver price stability. That's not ambiguity. That's a promise. And on top of all that, he launched 5 task forces to fundamentally rethink how the Fed operates. Everything from how they communicate, to how they measure inflation, to how big the balance sheet should be, to the role of artificial intelligence in economic analysis. BlackRock's Rick Rieder, who runs fixed income for one of the largest asset managers on the planet, called it a new era of monetary policy in the United States. Former Fed Vice Chair Roger Ferguson said the approach of building consensus through task forces is exactly how institutional change happens at the Fed. And the Evercore ISI strategist noted that new Fed Chair Warsh sounded a bit like old hawkish Fed Governor Warsh, referencing his previous stint on the board under Ben Bernanke. So here you are. The new guy is in charge. He's talking tough on inflation. Half his committee wants to hike rates. And the market? The market has taken notice. After the June meeting, futures were pricing in at least 125 basis point rate hike by October 2026. Traders on CME FedWatch were putting the odds of a September hike above 63%, even after the better-than-expected June CPI number came in. Bank of America went even further. Their economist came out with a call for 3 consecutive 25 basis point hikes in September, October, and December, which would push the federal funds rate all the way up to 4.25 to 4.5%. Deutsche Bank projected a 50 basis point increase for the year starting in September. These are not fringe voices. These are the biggest banks on Wall Street telling their institutional clients to prepare for rate hikes. Rate hikes. Not cuts. Not holds. Hikes. Do you understand how massive a shift this is? Go back to January. In January, the dominant conversation in every financial media outlet was, when is the Fed going to cut rates next? The expectation was that we were in a cutting cycle. Powell was still chair. Inflation was at 2.4%. Everything looked like it was gliding back to normal. Fast forward 6 months, and we're talking about the possibility of the first rate increase since July 2023. 6 months. That's all it took for the entire narrative to flip. And I'll be honest, this is the kind of environment that makes me think about Warren Buffett. Not Buffett the stock picker, not Buffett the billionaire, but Buffett the guy who got humbled by the 1970s. People forget this, but Berkshire Hathaway's stock dropped almost 50% during the stagflationary period of the mid-70s. Buffett himself has talked about how inflation is the single biggest tax on investors because it erodes the real value of every dollar of return you earn, he once said. And this is one of those quotes that hits harder every year, that inflation is like a tapeworm feeding on the economy's insides. And what we're living through right now has echoes of that same disease. Not the same severity, not the same decade, but the same mechanism. An external shock driving up costs, a central bank caught between crushing the economy and letting prices run, and ordinary people getting squeezed from every direction. The difference this time is that we have a Fed chairman who seems genuinely committed to not repeating the mistake the Fed made in the 1970s, when Arthur Burns let inflation spiral because he didn't want to cause a recession. Warsh appears to be saying, through his actions and his words, that credibility matters more than comfort. That short-term pain, higher borrowing costs, slower growth, maybe a weaker housing market, is worth it if it prevents the long-term catastrophe of embedded inflation expectations. Now let me give you the plot twist, because this story has one more chapter that changes everything. And it happened just days ago. On July 14th, the BLS released the June CPI report, and the number came in at 3.5% year over year. That's down from 4.2% in May. The monthly reading was negative 0.4%. The biggest single-month price decline since April 2020, when the pandemic was shutting the economy down. The consensus forecast had been for a monthly drop of just 0.1 or 0.2% and an annual rate of 3.8%. The actual numbers blew past expectations in the good direction. Core CPI, the measure that strips out food and energy, came in at 2.6% annually and was completely flat on a monthly basis. Zero. No change. Economists had expected 0.2% monthly and 2.9% annual. Both numbers came in meaningfully lower, and the driver was exactly what you'd guess: energy. Gasoline prices fell about 9.7% in June. The broader energy index dropped 5.7%, its biggest monthly decline since April 2020. That happened because of a ceasefire between the US and Iran that briefly eased tensions and reopened some oil flow. Shelter costs rose just 0.1% for the month, which is the smallest monthly increase since early 2021. Apparel fell 0.6%. Transportation services declined 0.3%. Even medical care commodities dropped. So the question that's now dominating every trading desk, every economics department, every retirement planning conversation in America is this: was the 4.2% May number the peak? Or is this June relief just a fake out? A one-month breather before the war reignites and oil spikes again? Because here's the thing nobody wants to say out loud: the ceasefire fell apart. Trump declared the ceasefire over after the two sides exchanged attacks. Oil spiked again, which means July's CPI could look very different from June's. Mark Zandi at Moody's put it perfectly when he said the biggest threat is that things unravel and we're back to full-blown war with the straight shutdown. If that happens, every bit of the relief we saw in June gets reversed and then some. And that's why the Fed hasn't relaxed. Fed Governor Christopher Waller came out and said it would take several months of positive readings to convince him inflation is actually moving back toward target. Several months. Not one good print. Several. The market is still pricing in a September hike with over 60% probability even after this encouraging June report. That tells you how deep the anxiety runs. Nobody trusts 1 month of good data when the geopolitical backdrop is this unstable. And here's what kills me. This uncertainty isn't just an abstract, macro debate. It hits real people in real ways that most financial commentators gloss over because they're too busy talking about the S&P 500. Think about credit cards. The average credit card interest rate in America right now is tied directly to the federal funds rate. When the Fed was cutting rates in 2024 and early 2025, credit card APRs came down a bit. But rates have been on hold for 4 straight meetings now at 3.5 to 3.75%, and if we get a hike, even a single 25 basis point hike, credit card rates go right back up. The average American household carries over $6,000 in revolving credit card debt. A quarter-point hike might sound small, but applied across millions of households carrying high-interest debt, it adds up to billions of dollars in additional interest payments flowing from consumers to banks. That's money that would have gone to groceries, to gas, to a family dinner, to a kid's birthday present, redirected instead to JP Morgan and Citibanks. Bottom line, mortgages? Same story. The 30-year fixed mortgage rate is heavily influenced by the 10-year Treasury yield and when the Fed signals hawkishness. When the dot plot shifts toward hikes, when the chairman talks about price stability a dozen times, Treasury yields respond. They go up, which means mortgage rates go up, which means the family that was just barely qualifying for a $350,000 house at 6.5% suddenly can't afford it at 7%. That's not hypothetical. That is happening right now to real people in real cities across this country. And on the flip side, and this is the silver lining that I think gets criminally underreported. If you're a saver, if you've got money in a high-yield savings account or a money market fund, higher rates are actually great for you. The Vanguard Federal Money Market Fund, one of the biggest in the world, was yielding 3.55% as of June. If the Fed hikes, that yield goes up. CDs go up. Treasury bills go up, for the first time in 15 years, you can actually earn a meaningful real return on your savings. But only if inflation doesn't eat it alive. And that's the tension, right? Higher rates help savers but hurt borrowers. They make credit more expensive but make saving more rewarding. And the Fed has to navigate that tension while simultaneously dealing with a war in the Middle East, a tariff regime that's still pumping cost pressures into the system, and a housing market that's frozen because nobody wants to sell their 3% mortgage to buy at 7%. It's a mess, an absolute mess. And the honest truth, and I say this as someone who spends every waking hour studying this stuff, is that nobody knows how this resolves. Not the Fed. Not Goldman Sachs, not Bank of America, not me. The range of outcomes is genuinely wide. Maybe the Iran situation de-escalates permanently, oil drops to $70, and inflation glides back to 2.5% by year-end. Morgan Stanley's chief U.S. economist said. He thinks we're at the peak right now and expects inflation to fall to 3.3% by December. That's the optimistic scenario. Or maybe the war escalates again, oil goes back above 100, and the Fed is forced to hike aggressively to prevent inflation expectations from getting unanchored. Bank of America's scenario of 3 hikes to 4.254.5% isn't a base case yet, but the fact that a major Wall Street bank is even putting that in writing tells you it's no longer unthinkable. I'm not going to pretend I have a crystal ball. That would be dishonest, and I don't do that here. What I can tell you is what I'm personally watching. I'm watching the July CPI number, which comes out August 12th. If June's improvement holds, if we see another print below 3.5, that dramatically reduces the probability of a September hike. But if oil is spiking again by then and the July number comes in hot, buckle up. I'm watching Kevin Warsh's language. He's only had one press conference so far, but every word he said was carefully chosen. If he starts leaning more explicitly toward a hike, the bond market will react before the Fed even votes. I'm watching core inflation specifically. Because here's the thing. Headline inflation is volatile. It swings with oil prices, with weather, with wars. But core inflation tells you what's actually sticky, what's actually baked into the economy. Core came in at 2.6% in June. If core stays near that level or drops further, the Fed can plausibly argue that the underlying economy is okay and the headline spike is temporary. If core starts climbing again, if tariff costs and shelter costs push core back toward 3% or above, that's when the real alarm bells go off. And I'd encourage you, right now, to take a hard look at your own financial situation. Not because I'm trying to scare you. I'm not a fearmonger. But because the environment has genuinely changed from where it was 6 months ago, and decisions that made sense in. January might not make sense today. If you're carrying high-interest debt, especially credit card debt, the risk-reward of paying that down aggressively just got better. If rates go up, your minimum payments go up too. If you're thinking about buying a house, understand that mortgage rates are unlikely to drop meaningfully anytime soon. And if the Fed hikes, they could go higher. That doesn't mean don't buy. It means go in with realistic expectations about what you're paying. If you're sitting on cash, the good news is your savings account is actually paying you something decent for the first time in a long time. Lock in a CD if you want certainty, or ride a money market fund if you want flexibility. But either way, don't let that cash sit in a zero-interest checking account earning nothing while inflation eats it alive. Nothing I just said constitutes financial advice specific to your situation. I'm sharing research and analysis, and you should absolutely talk to a qualified professional before making major financial moves. But the broader point stands: awareness matters. Understanding what the Fed is doing and why. Understanding the difference between headline and core inflation. Understanding how tariffs flow through to consumer prices. Understanding why a ceasefire in Iran affects your credit card payment. That knowledge is genuinely powerful. It's the difference between being reactive and being prepared. And this is exactly where the conversation gets dangerous, not because of the data itself, but because of how people misinterpret it. I've been watching the financial discourse online since the June CPI number hit, and I see the same mistake happening over and over. People are looking at that 3.5% June print, comparing it to May's 4.2, and celebrating like the war is won. Inflation is crashing. The Fed doesn't need to hike. Time to buy the dip. And look, I get the impulse. A 0.7 percentage point drop in 1 month feels massive. It is significant. But significance and resolution are not the same thing. 1 month of falling energy prices during a temporary ceasefire does not mean the structural inflation problem is solved. It means gasoline got cheaper for 4 weeks because 2 countries stopped shooting at each other, temporarily. The core issue, the stickiness underneath the surface, didn't go anywhere. Shelter is still running at 3.3% annually. Food is up 3%. Services costs, which are the most, labor-intensive and therefore the most tied to wages, are still elevated. And here's what kills me about the inflation is over crowd. They're ignoring the base effects that are about to make year-over-year comparisons harder, not easier, in the second half of the year. Let me explain base effects because this is one of those concepts that separates people who actually understand economics from people who just read headlines. When we say inflation is 3.5% year-over-year, we're comparing today's prices to prices from 1 year ago, June 2025. Now, In June 2025, energy prices were already declining. The year-over-year energy comparison in June 2025 was a 3.5% decrease. That means the base we're measuring against was already low. When you compare today's high energy prices to last year's low energy prices, the annual percentage change looks enormous. But as we move into the second half of 2026, the base starts to shift. By late 2025, the Iran conflict had already started, affecting oil markets, which means the year-ago comparisons will be against higher prices, not lower ones. That should naturally bring the year-over-year headline number down, but only if current energy prices don't spike again. And given that the ceasefire literally collapsed days after the June data was collected, that's a very big if. There's another base effect problem that almost nobody is talking about, and I only found this because I went deep into the BLS methodology. The government couldn't collect CPI data for October and November 2025. There was a lapse in federal appropriations, essentially a government shutdown, that prevented the Bureau of Labor Statistics from doing its normal survey work. Those 2 months are blank in the official record. They show up as gaps in the trend charts. What that means is that the 12-month averages and year-over-year comparisons spanning late 2025 are partially imputed, estimated, not measured. And those estimates may have introduced small but meaningful distortions into the baseline against which current readings are being compared. Analysts who are building models based on that data should be treating it with caution, and frankly, I haven't seen a single mainstream media outlet flag this. It's the kind of granular detail that gets lost in the noise but could genuinely affect how we interpret the trajectory. Let me shift gears and talk about something practical, because I know a lot of you watching this aren't. Wall Street traders. You're normal people trying to figure out what this means for your wallet, your family, your future. I want to walk through 3 specific scenarios and what each one means for your money. Scenario 1, the optimistic case. The Iran conflict de-escalates for real. Oil prices stabilize somewhere around $70 to $80 a barrel. The tariff regime stays roughly where it is, but doesn't expand. Core inflation continues its slow drift downward toward 2%. In this scenario, the Fed probably stays on hold for the rest of the year. No hike, no cut. Rates sit at 3.5 to 3.75% through December, and then maybe, we get a cut in early 2027. The practical impact for you. Mortgage rates probably drift sideways or slightly lower, credit card rates stay where they are, savings yields remain decent, and the housing market slowly starts to thaw as buyers and sellers adjust to the new normal. This is the Goldman Sachs base case as of their most recent outlook. They've been projecting core PCE inflation falling to about 2.1 to 2.2% by December, which would give the Fed cover to eventually ease. The JP Morgan research team also leans toward a hold for the rest of 2026, though they think the first hike comes in September 2027 if inflation doesn't cooperate. Scenario 2, the muddle-through. The Iran situation remains volatile. Periods of calm followed by flare-ups. Oil bounces between $80 and $100. Tariff costs continue to trickle through but don't accelerate. The Fed hikes once, probably in September or October, by 25 basis points, bringing the range to 3.75 to 4%. This is actually what the market has been pricing. One hike, then a long pause. In this scenario, mortgage rates probably tick up another quarter to half point. Credit card APRs go up. Auto loan rates go up. Student loan interest accrual goes up for anyone with variable rate loans. But savings yields also go up slightly, and if you're in treasury bills or money market funds, you're earning 4% or close to it with essentially zero risk. The trade-off is real, but manageable for most people. The people who get hurt worst in this scenario are those carrying heavy variable rate debt and first-time homebuyers trying to qualify for mortgages at the margin. Scenario 3, the worst case. The war escalates significantly. Oil goes above 120. The Strait of Hormuz gets shut down again. Tariffs expand. Maybe a new round targeting European goods over the Greenland negotiations or another escalation with China. Core inflation starts moving back toward 3%. In this scenario, Bank of America's call for 3 consecutive hikes to 4.25–4.5% becomes very real, maybe even understated. Mortgage rates could approach 8%. The housing market freezes completely. Consumer spending contracts. The word recession goes from whispered to screamed. And here's the gut punch. Even in a recession scenario, if inflation is still elevated, the Fed might not cut. That's what happened in the 1970s. It's called stagflation, and it's the nightmare scenario for central bankers because none of their tools work cleanly. Raise rates and you deepen the recession. Cut rates and you let inflation run. There's no good answer. I'm not saying scenario 3 is likely. The base case for most economists right now is somewhere between 1 and 2. But the tail risk is fatter than it's been in years, and anyone who tells you they know exactly what's going to happen is either lying or selling something. Here's what I want you to actually do. And I mean this. Take out your phone and do this today. First, check your credit card statements. Look at the interest rate on every card you carry, if it's above 20%. And statistically, most of you are in that range. Calculate how much interest you're paying per month. Then ask yourself, if that rate goes up another 0.25%, can I absorb that? If the answer is no, or even if the answer is that would hurt, make a plan to attack that balance. Second, if you're sitting on a pile of cash in a regular bank account earning 0.01%, and millions of Americans are, move it today. Open a high-yield savings account. Open a money market fund. Buy a short-term treasury bill. Your money should be working for you, especially in an environment where risk-free rates are 3.5 to 4%. Letting cash rot in a zero-interest account while inflation runs at 3.5% means you're losing purchasing power every single day. It's a silent tax, and you're volunteering to pay it. Third, review your investment allocations. This is not about panic selling or making dramatic changes. It's about making sure your portfolio reflects the current reality, not the reality of 6 months ago. If you're 100% in growth stocks with no fixed income exposure, you might want to think about whether that makes sense in a potentially rising rate environment. Bonds, especially shorter duration bonds, tend to hold up better when rates go up. Dividend-paying stocks can provide income that partially offsets inflation. I-bonds, if you can still get them, are literally designed to track inflation. Diversification isn't sexy, but it's the difference between surviving a storm and getting wrecked by it. And speaking of storms, I want to address the Kevin Warsh factor one more time because I think most people are underestimating how significant this leadership change really is. Warsh isn't just a new face in the same old chair. He represents a philosophical break from how the Fed has operated for the past 15 years. Under Bernanke, then Yellen, then Powell, the Fed became increasingly transparent, increasingly dependent on forward guidance, increasingly willing to tell the market exactly what it planned to do 3, 6, 12 months in advance. Warsh has explicitly rejected that approach. He didn't submit a dot. He stripped the policy statement down to 130 words. He said forward guidance was not well suited to the current policy conjuncture. He's signaling that the Fed under his leadership will be less predictable, more data-dependent, and more willing to surprise the market if conditions warrant it. That sounds great in theory. The original design of monetary policy was never meant to involve the Fed telegraphing every move months in advance. But in practice, reduced guidance means increased volatility. Markets that don't know what's coming tend to overreact in both directions. That's why the S&P dropped after the June meeting, even though rates didn't change. The uncertainty itself is a force. And those 5 task forces he launched are going to matter more than people realize. One of them is specifically reviewing how the Fed measures inflation, the actual methodology, the data sources, the survey response rates. Warsh himself pointed out during the press conference that many of the data inputs the Fed relies on come from old-fashioned survey methods with declining response rates, asking questions that may no longer be relevant. If the task force recommends changes to how inflation is calculated or targeted, that could have profound implications for policy. Another task force is examining the Fed's balance sheet, which Warsh has long argued is too large. He's been critical of the massive bond-buying programs, quantitative easing, that ballooned the balance sheet during 2008 and again during COVID. If the Fed accelerates its balance sheet reduction, what they call quantitative tightening. That has a tightening effect on financial conditions similar to a rate hike, even if the actual rate doesn't change. It's a stealth tightening that most casual observers won't notice until it shows up in tighter credit conditions and higher long-term yields. Now, I want to circle back to something I said earlier about tariffs, because there's a nuance here that I think is absolutely critical and that I haven't heard anyone else articulate this way. The tariff impact on inflation is asymmetric. What does that mean? It means tariff costs go up fast but come down slow, if they come down at all. Goldman Sachs literally wrote in a note to clients that they would not expect companies to lower prices in response to tariff reductions nearly as quickly as they increased them in response to tariff increases. Read that again. Companies raised prices fast when tariffs went up. They will not lower prices fast, or maybe at all, when tariffs come down. That's the ratchet effect. It's one of the most insidious dynamics in economics because it means that even if policy improves, the damage to consumer prices is largely permanent. The Yale Budget Lab estimated that even after the Supreme Court ruling that opened the door to tariff refunds, the remaining tariffs will still increase consumer bills by $600 to $800 per household on average. $600 to $800. That's not nothing. That's a car payment. That's a month of groceries for a family of 4 in a lot of cities. And here's the part that really gets me worked up. The people who bear the heaviest burden from both inflation and tariffs are the people who can least afford it. 3/4 of Americans in a recent poll said their incomes aren't keeping up with inflation. 3 out of 4. Household budgets are under pressure, with inflation outpacing wage growth for many workers. The K-shaped economy narrative, where wealthy households with investment portfolios and home equity are doing fine while lower-income households are getting crushed. That's not just a buzzword. It's measurable. It's real. And it's getting worse in an environment where energy costs disproportionately hit low-income families who spend a larger share of their budget on gas and utilities. This isn't a partisan observation. It's math. And if the Fed hikes rates, the people who get hurt first and worst are the people carrying the most debt at the highest rates, which, demographically, skews toward younger Americans, lower-income households, and communities that were already struggling before the pandemic. That's the human cost of monetary policy, and it's the part that gets lost when we're all staring at dot plots and CPI charts. If you've been watching this whole breakdown and you found it useful, or if you vehemently disagree with something I said and want to tell me why, hit subscribe to Failed Finance. I put out research-driven content on this channel because I believe that understanding the financial system shouldn't require an MBA or a Bloomberg terminal. You just need someone willing to dig through the data and explain it in plain language. That's what I try to do here. And if this specific topic, the Fed, inflation, rate hikes, is something you want me to go deeper on, tell me in the comments. Because there are angles I haven't even touched yet. The impact of AI on the labor market and how that feeds into the Fed's employment mandate. The ongoing debate about whether the 2% inflation target itself is still appropriate. Warsh explicitly took that off the table for now, saying he won't revisit the target until we have re-established our commitment and ability to deliver on the 2% inflation objective. The potential for a weaker dollar if markets lose confidence in the Fed's independence. Because remember, this chairman was appointed by a president who publicly pressured the previous chairman to cut rates. The question of whether we're heading into a period of jobless growth, similar to the early 2000s, where GDP expands but employment doesn't follow. All of these threads are connected, and they all flow back to the central tension we've been discussing today. Inflation is still too high, the Fed is shifting toward tightening, and ordinary Americans are caught in the crossfire. The way I think about it, and I'll leave you with this, is that the next 6 months are going to tell us whether 2026 is remembered as the year inflation peaked and started coming down for good, or the year the inflation monster came back from the dead and forced the most aggressive policy response since 2022. Either outcome is genuinely possible. The data we get in July, August, September, the CPI prints, the jobs numbers, the oil prices, the geopolitical headlines, those data points will determine which story gets told. And whichever story it is, it will affect your rent, your mortgage, your credit card payment, your savings, your investments, and your retirement. So pay attention. Not to the cable news sound bites. Not to the doom scrolling on Twitter. Pay attention to the actual numbers, the actual policy decisions, the actual mechanisms through which money flows through this economy. That's the real edge. That's the real advantage. Not a stock tip or a crypto coin or some guru's prediction. Just clear-eyed understanding of how the machine actually works. Stay sharp. I'll see you in the next one.